People always wonder, when is the best time to sell options premium? I mean, what's the ideal VIX or conditions should you go with when you're selling options premium? So in this video, we're going to tackle that subject. I'll give you a little more insight in this. Ultimately, I'll tell you, it doesn't really matter. You could sell options premium in low VIX or low volatility environments and high volatility environments, whether you're selling just put premium or you're selling verticals. You can do it in low volatility or higher volatility. Yes, there are some additional risks that go into different environments depending on what you're doing, and we're going to tackle that here in this video. Now, if you're brand new, I'm Sasha, the options coach. Been teaching people to trade options over the last decade, and got a ton of classes, courses, and other training material. If you're interested, check out the descriptions and our website. Anyway, let's kick things off. One of the things we tackled on one of the latest classes that we did recently was selling vertical spreads. I actually went and discussed with some people as an example of a higher volatility environment and lower volatility environment and selling premium behind this. Now, we specifically talked about vertical spreads, but you could also apply this to also just looking at selling single option contracts. Let me see if we did that class in here. Maybe it's posted somewhere else, just selling premium. Here it is, this one. It also applies to just selling put premium while you wait for the stock to drop as well. So anyway, the point is that when you go in, and a lot of people look at volatility and VIX levels, what you have to realize is that if we go into just the fundamentals of what this means, is volatility in simple terms means risk. Okay, that's all it means. So when you hear the word volatility, whether it's on the news thing, it's on an article, it just means risk. Now, when risk goes up, what happens? Okay, when anything goes up, the price of things goes up, right? So that's what's happening, is the price of things goes up. And if you're an insurance broker, in this case, the options world, the cost of those options go up. So let's say, let's take for an example, a buyer. Okay, so if you're a buyer, and normally down here at this level, you would buy a simple option for $300 or $3 for a contract. So multiply times 100, it's 300 bucks. Okay, well, this would be in a low volatility environment. You're just buying it for $300. Let's say now we take that same option and we go into a higher volatility environment. Well, now that option might be $1,200. So all of a sudden, you went up in price 4 times higher. So that's quite significant. If you're a buyer, that really is substantial. So now you're paying a lot more for options premiums and contracts. So if you bought something, though, here's the interesting part. If you bought something in a low volatility environment and all of a sudden price did not move, let's just forget price. Let's just assume price didn't even budge, but just the volatility went up. Now that option would be worth $1,200. Wouldn't that be great and amazing? So you just pocketed a whole bunch of money for nothing, for not even price moving, just the fact that the price of options went up. Now, this could be a really nice benefit to those things. Now, usually volatility moves because prices move and because of the fear or risk in those environments. So volatility in here, as we said, risk usually increases when the risk increases. It also increases the price risk. But what does that mean in terms of regular market? It usually happens when the price of stocks go down. So when they go down, usually the price of options increase. So if we're a buyer of options and we bought something for, $300, well, now we could sell it for $1,200. But the issue is that usually price is going down with it. So if you were a buyer of a put option, this actually accelerates your benefit and accelerates the risk premium for you. So it makes it a good thing. But if you're a call option buyer, it actually can hurt you in some degree. Okay, let's look at it from the sell side. So let's say you are a seller, and now you've got volatility levels at a high level. Okay, so we are now a seller at $1,200. And then, so we sold something and volatility levels now went down, and now the value of that option is $300. So you've sold something for $1,200 and now it's $300. You didn't even have to have price to move. You are benefiting right away, immediately, from that value of those options, just depreciated and decayed very quickly because you've already sold it. And now you can buy them back, okay, at a much cheaper cost, allowing you to profit without even price moving. Now, on the flip side, if we have the other problem, if you sold something for $1,200 even when volatility levels, let's say, were at a high level, okay? But now volatility went even higher, and now those options are, well, they're going to be worth more. Now to buy them back, now the cost is $1,800. Well, all of a sudden, what you sold for versus what you're buying for, think of it this way. Well, if you're buying something for $1,800, but you're selling it for $1,200, you're taking a loss. So that also becomes a problem. So when we look at selling options premium, and we look at, let's say, spreads of credit or premium, vertical spreads, or just a simple single options, I'll go in for the SPY options here. And we'll go about 34 days. Okay, so it is the weekend right now. Let's go 27 days. It's probably going to be a little bit more contracts over here. So what I want to show you here is that right now the volatility levels, based on what I have at the moment, because you'll be watching this in the future, is the VIX is right around 22. Okay, at this exact moment. I'll pull up a chart for you so you can see. Here's the VIX level. We are right around 22. So we were higher. Now we pulled back. So we're kind of at this level. Probably you could say at a lower level, we could actually spike up soon. Who knows? But the point is that right now, these volatility levels, okay, are a little bit lower. And these option premiums, okay, are a lot cheaper than what they used to be. Now, it's difficult to compare the option contracts exactly over here because prices shift. So one of the easiest ways to compare is the same DTE. So when you look at the same DTE and you compare the at the money price right here, we've got $10.76 roughly, or pretty much right around the $10 range. So if we are a seller of options and we are selling, let's just say premium on this one, the value of it is about 10 bucks. Okay, so it's $10 for a 27-day option. So if we're a seller, hey, that's 10 bucks. If we're a buyer, that's 10 bucks. Okay. Now, in a different volatility environment, this might be completely worse or better. So right now we are at volatility of 22. But if we go back to when, let's just pull up here the VIX, and I want to show you somewhere around 474849. We're going to go into the analyze here, and I'm going to go to think back. And I will go to 474849. Let's just go to 47. We'll type in the SPY, and we're going to compare it to the one that option that we did was the SPY of 27 days. Let's just go right there. Okay, one strike. No, let's go 5. 5 strikes at about a 27-day option. We said it was about 11 bucks. Okay, so 27-day, 11 bucks. We'll go back to the analyze. We'll go to the think back. And what we can do here is we'll collapse this. Let's get rid of this chart. Okay. We'll go to about a 25-day option because it's fairly similar. Okay, and those option prices were $17. So you can see the big difference is that you're right around that $17 range for even shorter duration options compared to right now, you're at $10.76, 27 days. So think of the difference, $17 versus, again, $10.76. So you are basically almost doubling up the price when the volatility levels are higher. And that's what I want to show you. This is what we did in our class and lesson. I was comparing kind of the options between 213. This was also of the SPY of looking at 29-day options right here, as you can see, versus the 30-day options. So some of these option contracts were right at the money. We're at $7.70 versus $22. So almost 3 times difference. And if you look at the call side here, about $22 versus about $10, so almost double the price. So my point here is that when you are selling options premium, you might say that, hey, it is a better deal to go into, and this, you might have heard this before, sell when the VIX is high. And this might be a good point or premise, because when you think about just the concept of, do you get more money from selling those option premiums? Yes, you do. But remember, you actually are doing something with the risk. So because you are getting more premium, you are also taking on more risk. So is it necessarily better to sell option premium when the VIX is high? Yes and no. It's better in the sense that you get more premium, but the trade-off for that, what you have to give up, is that you're actually taking on more risk. So you get more money because you get more risk, because the market is more turbulent. Now, a lot of other people, they actually prefer to sell option premium in a low volatility environment, and because the market's going up. And when you sell, let's say, vertical spreads on the put side, or even just put premium, well, the market just constantly, is trimming or going to the upside and going to the upside, and it seems easy and it's consistent, and that actually might be more peaceful. And there's nothing wrong with doing that. However, the downside is that when things go against you, the volatility levels increase and impact you quite a bit if you're not hedged or protecting yourself against this, or trading small enough to where you can, modify the positions. But overall, some people like the consistency of that. When the market is trending higher here, they are selling and selling and selling and selling and selling premium, because we're grinding to the upside. When the market's tanking, yes, you are getting more premium and more bang for, call it, your options. You're able to sell it for more money. But the issue is that you are getting more risk. So I think it's important you look at it in terms of the context. Not necessarily just, hey, do I sell option premiums when the VIX is low, or when the VIX is high, or in the middle? It really comes down to a little bit more of your personality trait. If you think it's a good opportunity and you might get a bounce soon, yeah, if you're selling put premium, that could be a good, smart bet and play, because you're going to get more for the premium, or you'll just be able to get more range. Because in a lot of cases, if you're collecting $10 in premium in a normal condition, but now you can get $25 in premium in a high VIX environment, yes, you're getting more premium, but what that allows you to do is that when you go in and sell puts, instead of, let's say, current prices here at $500, and you sell the put at $400, well, now in a higher VIX environment, to get that same premium, you're trying to collect, let's say, $125 of premium. Well, to get that same $125 of premium in a higher volatility environment, you might be able to get a range of selling premium in the $300 range, giving you an extra 100-point of wiggle or range to be able to sell that same amount of put premium. So that's really the advantage in a higher volatility environment, is that you get more range, and that makes it kind of interesting or advantageous. But you have to be aware of these things, that you might actually, get more range because, well, you're in a higher risk environment. You're getting more premium. Yes, it all sounds good and juicy, but the reason you're getting it is because of the additional risk that's in the marketplace now. So anyways, hopefully this answers your question as far as, hey, is it a good idea to sell premium in a high VIX environment or a low VIX environment? It's really going to depend on your personality or your personal taste. But at the end of the day, selling a premium in a high VIX environment, yes, you do get more juice out of that premium on the options you sell, but you also have more risks. And if you do it in a low volatility environment, you actually might be going with the trend, and it might be more consistent. And I guess everybody has their own different tastes and opinions of things they like. It's just realize that there's trade-offs in any of these scenarios. It's not that one is better. It's better how and in which way is it better. One is better in terms of the premium collected or the range that you might be able to get. The other one might be more in peace and tranquility. As it trends higher, you're probably going to win trades, but you're making less on the premium. So anyways, thank you so much for joining me in this video. If you're interested in some of the classes, check out the description, video, or our website, and I will see you on the next one. Take care.